All right, let's talk about accounting. For a lot of people, that word just sounds, well, boring, right? Like taxes and spreadsheets. But what if I told you it's actually a language? In fact, it's the most important language in business, the one that tells you if you're winning or losing.
So, picture this. You've finally done it. You launched your own business. It's exciting. You're seeing money come in, but you're also seeing money go right back out to pay for things. And at the end of the day, you're left with this huge question mark hanging over your head. Am I actually making a profit, or am I just busy?
You know, the best way to get a handle on this stuff is to see it in action. So for this explainer, we're going to follow a guy named Joe Perez. He's just started his own company, a delivery service called Direct Delivery Inc., and he's facing these exact same questions. Let's see how he figures it all out.
Okay, so if business is a game, how do you know if you're winning? Well, you need a scoreboard, right? And in business, that scoreboard is a set of financial reports that cut through all the noise and give you a clear picture of how your company is really doing.
Now, the two most important parts of that scoreboard are the income statement and the balance sheet. And here's the easiest way to think about them. The income statement is like a movie. It shows you the story of your business over a whole period, like a month or a year. The balance sheet, that's a photograph. It's a snapshot, freezing a single moment in time to show you exactly where you stand.
So let's break down the lingo. First up, revenues. This is the money your business earns. For Joe, that's what he gets for every delivery. But notice that word, earns. This is super important. It's not about when the cash actually hits your bank account, it's about when you did the work.
And on the flip side of that coin, you've got expenses. These are all the costs you have to pay to make those revenues happen. It's the gas for Joe's delivery van, the salaries for his drivers, the packaging materials. You get the idea. It's the cost of doing business.
Now let's jump over to that photograph, the balance sheet. First up are assets. These are basically all the valuable things the company owns. We're talking cash, sure, but also things like equipment, buildings, and for Joe, his delivery van. They're resources that are going to help him make money down the road.
And if assets are what you own, liabilities are what you owe. It's the other side of the story. Maybe Joe got a bank loan to buy that van. Well, that loan is a liability. It's an obligation his company has to pay back. Same goes for any bills from his suppliers that he hasn't paid yet. And just to round things out, there's a third, really crucial report, the statement of cash flows. This one is simple. It just tracks the actual cash coming in and going out. Because here's the thing, you can look profitable on paper, but if you don't have enough actual cash to pay your bills, you're in big trouble.
Okay, so we've got these scoreboards, but for them to mean anything, for anyone to be able to trust them, everyone has to play by the same rules. And the biggest, most important rule in the whole game, well, it's all about timing.
And that big rule has a fancy name, accrual accounting. But don't let the name intimidate you. All it means is that you record revenues when you earn them and expenses when you incur them. It doesn't matter when the cash actually moves. It's about matching the work with the reward. Let's go back to Joe's business. This will make it crystal clear. It's December and direct delivery is crushing it. They deliver 1,000 packages and earn $4,000. Joe sends out all the invoices, but his customers don't actually pay him until January.
So here's the big question. When did direct delivery actually make that money? Was it in December, when they did all the hard work? Or was it in January, when that $4,000 finally landed in the company's bank account? What do you think?
And the answer, according to the rules of accrual accounting, is December. No question about it. You record the revenue in the month it was earned. This gives Joe a way more accurate picture of his business because it matches the income he generated in December with all the expenses from December that it took to earn it. So how in the world do you keep track of all this stuff? The revenues, the expenses, the assets, the liabilities, and make it all balance out? Well, the system that makes it all possible is kind of genius, and it is way, way older than you probably think.
Get this. The core system that powers all of modern finance was first written down in detail way back in 1494. Yeah, 1494. It was published by an Italian friar and mathematician named Luca Pacioli. It's called double-entry bookkeeping, and this 500-year-old idea is still the gold standard today. Isn't that wild?
The central idea is so elegant and simple. Pacioli realized that every single transaction in a business has two sides. There's always a give and there's always a take. You can't just have one. For everything your business gets, it has to give something up. This idea of perfect balance is the key to everything.
And this all gets captured in one powerful little formula, the fundamental accounting equation. Assets equals liabilities plus equity.
It just means everything the company owns, its assets, is claimed by somebody. Either it's claimed by outsiders, like a bank, those are the liabilities, or it's claimed by the owners, that's the equity. And this equation, it has to stay in balance, always.
Okay, enough with the theory. Let's see how this actually works. We're going to take a simple, everyday transaction from Joe's company and watch this double entry system do its thing.
So let's say Joe's company buys that delivery van for $14,000 cash. What's the give and the take here? Well, step 1, the company pays cash, so its cash asset goes down by 14 grand. Step 2, what does the company get? A van, so its vehicle's asset goes up by that exact same 14 grand.
And here's what that looks like in the books. Now, you'll see the words debit and credit. Don't let them scare you. It's just accountant speak. Think of debit as the get side and credit as the give side. So we debit vehicles because that asset increased, and we credit cash because that asset decreased. The amounts are the same, and the equation stays perfectly balanced. The company just swapped one asset for another. Simple as that.
You know, this whole elegant system, this entire language of business, it all hangs on one single thread: trust. For Joe to go to a bank and get a loan for another van, that banker has to trust that his numbers are real. This is why accounting is so much more than just crunching numbers.
That trust is built on a really strict code of ethics. We're talking about fundamental principles like integrity, just being honest and straightforward, and objectivity, not letting your own biases mess with the numbers. These aren't just suggestions. They are the rules of the road that make sure the whole financial world doesn't just fall apart.
So, in the end, accounting isn't really about looking in the rearview mirror. It's about giving you a map for the road ahead. The numbers tell a story of where you've been, sure, but more importantly, they help you decide where you want to go. So, the question I'll leave you with is this: what story are your numbers trying to tell you?